So we have a couple main takeaways from earnings season. First of all, the bar was pretty low going in, and I would say that in general, things were better than feared across the board. Under the hood, a couple trends emerged to us. One, goods versus services, the transition we've been talking about and rebalancing the economy from post-COVID distortions is definitely underway. And so goods producing companies did have a very difficult time, but people continue to pay up for services, and that's coming through in earnings trends. Second, cost cutting is still a thing, especially at technology and technology adjacent companies, and the market is rewarding these companies for that as they protect their margins as inflation comes down. And lastly, one thing we noticed is post-releases, companies that beat their earnings did not do as well as they have historically, whereas companies that missed their earnings did worse than they have historically. So the market is punishing the losers more than it's rewarding the winners. And what that tells us is a little bit of a lack of sponsorship from the fundamental investment community. The reason I think that is important is that the market has done pretty well, and so there's a little bit of a disconnect between the high-level index performance and what we've seen under the hood on a stock-by-stock basis during this earnings season. So this is likely the last Fed hike. We went back and we looked at the change in the statement that was done in the 2006 around that last hike in that cycle, and it very closely mirrors what we saw just in the statement released this past Wednesday. Furthermore, the Fed is very concerned about the overhang from the banking stress that's continuing to go on in the background. This is not an acute crisis, this is not 2008, but it is something that's going to matter for credit transmission to the real economy. And so the Fed is factoring that in and thinking that we're likely at the place where they're going to pause and keep rates on hold for a while. Now, the context there, though, is the market thinks they're going to cut almost 4 times for the rest of this year. And so, the market and the Fed are once again quite disjointed from each other. We're closer to the Fed on this than the market, and think that the market pricing is a lot of insurance around a recessionary type environment where we would actually likely see even more action that's currently priced in. And one thing on those cuts, there's a lot of investors that are kind of taking a look at this current situation and saying it's similar to 2019, where the Fed cut interest rates 3 times and stocks continue to rally into 2020. And what I would say is this is a little bit of a different situation. If the Fed is going to be cutting interest rates today with inflation around 5%, they're doing that because there's major stress in the banking system that's going to really impact growth. And the read-through to that is likely to be a recessionary type environment. And so that's not nearly as positive, I think, as some investors are thinking about this time around compared to the last time we saw some preemptive Fed cuts. So we definitely feel like we're at an inflection point in the macroeconomic cycle, as the Fed is pausing and companies are not really giving a whole lot of earnings guidance for the rest of the year. And so I think this is a really important point where we're watching just a few key indicators across the board to see kind of where we're going within the kind of the three-path framework that we laid out in our recent quarterly focus article. And so the one thing that we're watching, if we're going to see a slowdown in the economy due to credit concerns, it's likely to hit small businesses first. And so we're paying even more attention to that sector than we are normally, especially since they're the vast majority of employers of workers in this country. And secondly, the labor market is really key to this entire outlook. It's very difficult to bet against a U.S. consumer that is employed. They are going to continue to spend. That's been something that's been underlying our more optimistic growth forecast for over a year now. And so, watching the labor market for leading signs of weakness is something that's really top of mind for us. On that front, we are starting to see a little bit of a loosening in some of the tightness that we saw last year. I think that's a really healthy thing in the context of inflation, but it's something that we're definitely paying an eye on because it could, continue a little bit stronger than we would like, and the Fed would like as well. And lastly, can't put inflation out of the equation. Goes a little bit to what wages are doing, but it also is a potential toggle to allow the Fed to have a little bit more leeway to cut rates or not, depending on what happens with growth and what happens with the banking system and the overhang that we do expect to matter for the rest of this year. And so, summing it up, a really important time for the economy and for markets, and a lot of cross currents that we're watching very, very closely.